I call this meeting to order. This is meeting number 31 of the Standing Committee on Finance. Orders of the day, pursuant to the order of reference of Tuesday, April the 8th, 2014, study of Bill C-31, an act to implement certain provisions of the budget tabled in Parliament on February 11, 2014, and other measures. We have with us, I believe, half of the public service of Ottawa here in the room. We want to welcome all the officials, thank them so much for spending this afternoon and obviously the rest of the sessions on the budget bill with us. We have before us at committee, we have right now seated before us, we have Mr. Ted Cook, who's been here many times. Welcome back to the committee, Mr. Cook, from the Department of Finance, and also Mr. Miodrag Jovanovic. Am I saying that correctly? Yes. Welcome to the Finance Committee. Colleagues, we obviously have a very comprehensive bill to get through over this day and Tuesday with the Minister as well. We have 6 parts to this bill, so I'm proposing to go through, obviously, starting Part 1, moving through to Part 6. And as well, I'm proposing that we follow our normal question rotation. So we'll start with the NDP, move to the Conservative, then Liberal Conservative, and successfully through the rest of the rotation. Proposing 7-minute rounds, at least for the first while. We can move to 5-minute rounds later. I'm asking that you focus in particular on the items you want to highlight and get officials on the record. You've all had a briefing. You and your staff have had a briefing on the bill prior to this, and you also have the full document from the Department of Finance has been provided, as well as the document from the Library of Parliament. So what I'm proposing to do then is to go to, we'll start with the NDP on their round, and if members do wish to have an overview of a certain section, they can point to that. But I'll just highlight for members, if they ask for an overview of Part 1, it'll likely take a 30-minute overview, so that'll likely take up an awful lot of question time. So we will start with the NDP, and I'm going to go to Mr. Cullen first, please.
Thank you, Chair. Just a brief comment. Mr. Caron will be taking most of our time on Part 1 through 4, where we will hopefully spend less of our time with a significant amount of our interest. I say this for our officials who, as it is good to have half the civil service with us here today, and appreciate you being here. The sections on FATCA, certainly a large trade treaty with our largest trading partner, the Americans, preoccupies us a great deal, as well as the rather extensive sections, Part 6, that are encompass. The challenge we have, Chair, as we've spoken about, is with such a massive omnibus bill, being able to have the committee properly understand all the implications. As we've seen, there's been problems with previous omnibus legislation where unintended consequences seem to be part of the day, and that future omnibus bills fix the mistakes in previous omnibus bills. So we're looking to help the government out here a little bit. They've thrown everything in the kitchen sink in this one, and we'll get right through it with Mr. Caron, and I'll come in on a section on Part 2. Thank you, Chair.
Government will appreciate your
I'm sure they will.
On this
Every comment we make, I'm sure.
Okay. Mr. Caron, s'il vous plaît.
Merci beaucoup.
Thank you very much. I have 5 minutes or 7, sorry. Welcome to the committee. Once again, I have a few questions regarding Part 1, and if I don't have time to finish, perhaps I'll come back to this. My first question pertains to fiscal measures, non-compliance. It encompasses Parts 1, 2, and 4, if I'm not mistaken. When we talk about whistleblowers, the first question I would have is that there's also another program called the Information Provided by Whistleblowers section, Budget 2014, and this bill establish a whistleblower program targeting people in foreign countries. What's the difference between the two programs, the whistleblower program and the one pertaining to information provided by a whistleblower? What's the situation? What's the difference between the two programs?
I'm not familiar with the other program. There's one that's not in Part 1 or 2, 3, 4.
Yep. Dans le projet de loi budgétaire, il y a la création.
In the budget bill, there is this program that is established. It's for non-fiscal compliance in foreign countries, and there's already a program, according to the Revenue Agency, that pertains to information provided by whistleblowers or informers. I don't have the English title. I have the French title in front of me. So what's the difference between these two programs? And why would a whistleblower call upon one rather than the other program?
Program you're talking about, the existing program with CRA, so I'll explain a little bit about that, and then I'll explain in more detail the OTIP program, which is actually contains in the budget. The Canada Revenue Agency currently has what they call a LEADS program, and under the LEADS program, it's actually just voluntary disclosure of tax non-compliance that people do on a voluntary basis, and there's no kind of monetary reward or particular system set up around the management of it. So Because it is purely voluntary and there's no kind of rewards, it has not been extensively utilized. Obviously, the expectation is that if you provide an incentive, you're more likely to get a greater response. If you would like, I can spend a little bit of time talking about the offshore tax informant program and how it's set up, and you'll see that it's different than essentially what's a voluntary line where people can call in, and if they have particular instances of non-compliance that they want to identify. With respect to the offshore tax informant program, it's different in a number of ways. Firstly, it only relates to tax non-compliance, ultimately, of taxes, federal taxes of in excess of $100,000. So it's instances of non-compliance of that order is what the program relates to. As well, there has to be an international component to the non-compliance that's identified. That can be income earned offshore or assets that are transferred offshore that relate to taxable income earned in Canada. Under this program, which was originally announced, under this program, basically the CRA can enter into a contract with someone where they will potentially receive payment of between 5 and 15% of taxes collected, and they'll only get that amount once all appeal rights have been exhausted.
J'aimerais savoir si vous êtes au courant, parce que...
I would like to ask you, the program, the LEADS program, do we have an idea of the results it has delivered? And through this new program, is it your intention to eliminate the LEADS program?
Of any intention by the CRA to eliminate the LEADS program, as I've indicated, the new program only relates to more significant tax non-compliance and taxes in excess of $100,000, and then have an international component. Those are not limitations under the LEADS program. Under the LEADS program, my understanding is somewhat on the order of less than around 10% of the leads that are provided actually result in assessments. So the hope is that by having a more rigorous relationship with the informant, that it will increase the number of assessments that result.
30 secondes, je vais espérer.
I probably have one or two other questions, so I'll wait. Thank you.
Chair, and thanks to our witnesses for being here today as well. My first question is regarding the Foreign Account Tax Compliance Act, or more commonly known as FATCA. Sorry? Can't do Part 5? I thought we were doing 1 to 6.
We're starting parts 1, and then we'll move through successfully.
Okay, then I will change my question.
Okay.
And I will ask a question regarding the mineral exploration tax credit for flow-through share investors. Now, coming from the province of British Columbia, the mining industry is a large part of our economy. And in fact, mining is extremely important to the Canadian economy as a whole, including the northern and rural communities. In fact, I understand that 80% of global mining companies are listed on the TSX here in Canada. Now, underlining how important the sector is to our economy, our government has offered support for these job-creating businesses with the Mineral Exploration Tax Credit, which is renewed in Economic Action Plan 2014. Can you please explain how the Mineral Exploration Tax Credit helps businesses in Canada, and can you explain how important this tax credit, important tax credit works?
I'll be happy to do that. With respect to the Mineral Exploration Tax Credit, it relates to flow-through share investors. Under a flow-through share investment agreement, a person can purchase shares from what's generally a junior mining company. Junior mining companies very often do not have enough expenses to do not have enough revenue to fully offset their expenses. So under a flow-through share agreement, those expenses can be renounced by the junior mining company to the flow-through share investor. The expenses that are eligible to be renounced relate to essentially sort of greenfield exploration, prospecting, sampling, that kind of thing, geophysical, geothermal, geochemical analysis. expenses can be renounced to the investor up to the amount of the share investment. And then the mineral exploration tax credit provides a 15% credit on the amount of expenses that are renounced to the shareholder. Now, to fully take into account the effect of the fact that expenses are renounced and are deductible by the individual investor, and as well you've got a 15% tax credit, then in the year following, the year in which the claim is taken, there's an income inclusion in respect of the amount of the credit. Certainly a number of industry associations have indicated the importance of this credit to their prospecting activities. And in particular, I had talked about junior mining companies. It's of particular importance to them. As I indicated, they may have mining expenses, exploration expenses that they're not able to take into account in computing income tax.
Thank you. Our government introduced the volunteer firefighters tax credit a few years ago, and more recently, this was to recognize those Canadians who put their lives at risk on a regular basis to help save the lives of other Canadians. And we've also now expanded that to include the volunteer search and rescue Canadians as well. And so my question to you is, how is it going to work? Because in my riding of North Vancouver, we have a unit called the North Shore Rescue, which they put their lives at risk every day to help, save the lives of other Canadians. So my question is, how is this new tax credit going to work to the benefit of those volunteer Canadians who put their lives at risk?
With respect to the search and rescue volunteer tax credit, if an individual provides 200 hours or more of eligible search and rescue volunteer services, and they're provided to an eligible search and rescue organization, then that individual will be able to claim a non-refundable tax credit on the order of a credit that is based on the amount of $3,000. So the credit would be 15% of that, or approximately $450. I guess the one thing I would highlight for the committee, well, I guess there's two things I'd highlight for the committee, that if an individual is performing both volunteer firefighting services and volunteer search and rescue services, those hours can be aggregated for the purposes of either credit. So if you had 100 hours of search and rescue volunteer activities and 100 hours of volunteer firefighting activities, then you would be eligible for the credit. But I would also note that any particular taxpayer will only be eligible for one of the credits. They would be, if someone performed 400 hours of service, they would choose whether they wanted to claim the volunteer firefighter tax credit or the search and rescue volunteer tax credit.
Thank you. Thank you, Chair. I have no further questions.
Thank you very much, Mr. Saxton. We'll go to Mr. Bryson, please.
Thank you, Mr. Chair. And I'd like to follow on Mr. Saxton's questions on the volunteer tax credits. These credits exclude many deserving volunteers who put their lives at risk and incur costs as volunteers because they're non-refundable tax credits. And there's a lot of volunteers both in search and rescue and in volunteer fire departments who do not make enough money to actually benefit from these as a non-refundable tax credit. Another issue is that, and I would like you to confirm this, somebody who is both a search and rescue volunteer and is also a volunteer firefighter must choose between these two tax credits. They can't claim both credits in the same year. Is that accurate?
I'll just answer your second question first, because my
Sure.
colleague can respond to your first question. But that's exactly right. If a person, even if they do have 200 hours of search and rescue volunteer hours of service plus 200 hours of volunteer firefighting, they would only claim one credit.
Sure. On the non-refundable nature of this tax credit, have you examined how much it would cost to extend this benefit to low-income volunteers by making it refundable?
With respect to refundability, I would first note that refundable tax credits are used in very limited circumstances in our income tax system when there's a clear policy rationale to do so. Like, for instance, I would say the working income tax benefit, for instance, is refundable because it is directed at low-income individuals. The intention is to create an incentive for these people to enter or stay in the labor force, so it makes sense that this credit be refundable. Otherwise, when credits are there to recognize, either generally recognize specific expenses or a reduced ability to pay tax or specific circumstances of taxpayers or situations, then these credits are generally non-refundable. So that's the general policy.
So you're saying that WITB is refundable because it's aimed at low income. So the volunteer tax credits described are not aimed at low income.
Because the policy objective is different.
Is to exclude?
It's not targeted to low-income individuals. It is the intention is not to provide income support, or in the case of the working income tax.
But it does provide income support to people who make enough money to qualify.
The objective is to generally recognize these individuals by providing a tax relief, so a reduction in a tax liability, basically.
So low-income volunteer firefighters do not deserve the same recognition as volunteer firefighters who make enough to qualify. Is that the public policy rationale?
Well, to the extent that the objective is to reduce tax liability, if these individuals already have a tax liability that is nil, then...
Has the department done any analysis on how this plethora of non-refundable tax credits actually may be contributing to greater inequality by excluding low-income Canadians?
I'm not aware of any specific study would have assessed that.
Thank you. The mineral, to follow on Mr. Saxton's question on the flow-through share tax credit, what is the rationale for extending this tax credit? I mean, it's been around for a long time. What's the rationale of extending this on a one-year basis over and over and over again? It doesn't seem to make a lot of sense from the fact that 80% of mining financings in the last 10 years, I think, were transacted in Toronto. Not that there's been a lot of mining financings in recent, the last couple of years, but wouldn't it make more sense just to put it in place for a longer period of time, and as opposed to every year? What's the public policy rationale of renewing it every single year?
Well, certainly the decision to invest or not, and by investors and by mining companies, is based on a whole host of factors, some of which are not connected to the tax system, and I can only respond to this year's extension to it. And you're quite right. I mean, it has been annually extended since, I believe, 2007. Now, with respect to the extension of this year, the overall sector has been fairly strong, but there's been recent drops in certain commodity prices with respect to base and precious metals that was felt supported the continuation of this particular credit.
Okay, thank you. For the pension transfer limits, can you provide us with some examples of situations where the new rule might kick in?
Well, in terms of the pension transfer limits, so I'm just flipping to the correct page. There may be situations where, under the current rule, it requires two things, two main things of import. One is that the employer is insolvent, and also that the pension plan is being wound up, and that will no longer be required if the reduction in the pension benefits is allowed under the relevant pension standards legislation. So an example would be actually where the pension plan is not being wound up, where they're trying to work, sort of save the pension plan, And if people are being transferred out, are transferring out, then the non-reduction, if you will, of the transferable amount is potentially applicable.
We're right up against your 7-minute time, so.
Okay, so we'll come back.
Yeah. Okay, thank you. We'll go to Mr. Allison, please.
Thank you. Thank you very much, Mr. Chair, and thank you to our witnesses. I had the opportunity to sit as the founding board member of the Dave Thomas Foundation for Adoption, and there's a number of things that organization has done in Canada. Some of it's been, surveys in terms of trying to find out attitudes and adoptions, and I just note that they commissioned the Canadian Foster Care Adoptions Attitude Survey, so trying to indicate what are some of the issues and how we can get more kids adopted. And what we found out is there's some 30,000 kids in foster care, which is always a challenge in and out, and that if only 0.5% of people actually adopted who were thinking about it, we would have all those kids out of foster care. However, one of the things that was discovered is the cost of actually being able to adopt kids. I know that we've got the adoption expense tax credit. I know that's great, but could you guys explain exactly how that will work in terms of what costs, or how much, and how it differs from where we're at now? And
Sure. I guess maybe my colleague might make some further comments on the particular credit itself, but the change that's being proposed in this bill is actually fairly simple. In the adoption expense tax credit is a non-refundable credit that's indexed to inflation each year, and without this amendment, the expense limit for the credit would be on the order of about $11,800. So what this measure would do is simply increase that $11,800 to $15,000 for this year, and because it is an index credit, then it will increase with inflation sort of year after year. So that's fairly straightforward. In terms of dealing more generally with your question, I'd also note that in Economic Action Plan 2013, the period for which expenses can be eligible for the credit was extended to start the adoption period earlier in certain cases. So I think all those are just sort of additional, I guess, removal of disincentives to adoption, if you will, relating to the cost of adoption.
so what? I understand the tax credit works based on incomes, et cetera. So what kind of tax savings then can this mean to an individual family if they were able to push up against the $15,000 limit?
Just to address that briefly. So what it does is, because non-refundable credits are creditable at 15%, it offers approximately $500 in tax relief.
Thank you very much. I'm going to turn over to Mr. Keddy.
You've got 4 minutes.
Okay. Thank you, Mr. Chairman. Welcome to our witnesses. I want to revisit the Search and Rescue Volunteers Tax Credit and the Volunteer Firefighters Tax Credit for a second. Was my understanding that the changes to this tax credit will allow someone who participates both in search and rescue and is a volunteer firefighter to actually combine hours. And if they have 100 hours of search and rescue and 100 hours as a volunteer firefighter, they will qualify for the credit. This is in most of rural Canada, many of these search and rescue volunteers and volunteer firefighters may not get their full 200 hours of volunteer time. So this opens this credit up to a tremendous number of volunteers. Do we have a real number, or do we have an estimate of how many more people will qualify under these changes?
Yeah, I give you the numbers here. Well, our estimate is based on what we could observe as like number of members currently as either in the air, ground, or marine search and rescue associations, which are roughly about 19,000 individuals. We don't have much information to determine what's going to be the take-up from there, but that's the primary figure, basically.
So potentially, we could have another 19,000 volunteers across Canada eligible for a tax credit who were never eligible
Potentially.
prior to this. Excellent. I've got a question on 4B, on mobile offshore drilling units. I mean, we've worked as a government to reduce the corporate tax rate and reduce the small business tax rate. In Economic Action Plan 2014, we built on those measures by eliminating the 20% most favored nation rate on mobile offshore rigs. The challenge that I'm when looking at
Mr.
this,
Kay, that's not part one.
is 4B. You said 1 to 4.
No, we're doing part one. Because this is how the officials are being presented to the committee, is
I
part one.
apologize, Mr. Chairman. We're stuck on one system here. I'll back up to. We're trying to move ahead, and I'm losing time as I'm talking. On the medical expense tax credit, can you explain what measures will be eligible under the proposed amendments in this year's budget, and who is eligible to claim the medical expense tax credit? How much is it expanded?
The medical expense tax credit is changed in two ways under this bill. The first is to add service animals for people with severe diabetes. So it's called diabetes alert dogs. The cost of acquiring these dogs, the associated training and travel, and the care and maintenance of these dogs will be eligible for the medical expense tax credit. What these dogs do is they can actually, through scent, determine changes in sort of the blood sugar levels of individuals and alert them to the fact that that's occurring. The second part of the measure is to allow the medical expense tax credit to be available in respect of what we call individualized therapy plans. There are certain plans of therapy, when they're undertaken, will be are currently eligible for the medical expense tax credit, but sometimes to undertake these therapies, a plan has to be developed in the first instance, and this measure would ensure that these the development of these plans, which relate to therapy that is itself eligible for the medical expense tax credit, will also be eligible. Just in terms of the quantum, there's not very many of these dogs coming into Canada yet.
Okay, thank you, Mr. Kitty. I'll just explain. Sorry, colleagues, I thought I was clear about this. The reason for doing it this way is we have different officials who will come to address different parts of the bill and different divisions of the bill, and so we can't keep swapping in and out people at the table. So that's why we're proceeding in this fashion. So we'll stick with part one. We'll go to Mr. Cullen, please.
Thank you, Chair. I'll keep my questions brief. Just I want to get back to the flow-through shares tax credit for mining. Represent a resource-rich part of the country in northern British Columbia, and this is an important issue. My two principal questions. Last time you presented, Mr. Cook, you talked about that, and again today, the association of other factors, the effect of the tax credit. We seek tax credits that help with efficiency and also produce results. Has the department done a study as to what the impact has been over these, is it 7 years of renewal on this particular tax credit, to understand what the impact has been for the mining exploration economy?
I guess there's two ways to answer your question, and I can only provide information relating to one. In terms of the actual take-up and application of the credit itself, we've approximately in 2012, the last year for which we've got data, approximately 350 companies issued flow-through shares, and they were applicable in respect of between 30 and 40,000 individual investors. And that's approximately, they raised about $750 million through these shares to be applicable for investment. Your other question, I think maybe is, what's the margin? And I don't have a figure that I can provide you as to the marginal impact.
I don't know if we're using the same terminology here, but less so the margin, but what the broader economic impact. we trying to understand the effectiveness of tax credits, and any program run by the department is to understand, in the absence of that program, what would be the resulting activity. On mining exploration, the idea, I believe, of this particular program is to incentivize exploration that otherwise would not happen because of, say, depressed mineral prices or a cooling investor climate. Am I right so far in my understanding of this program?
It's generally correct.
Generally correct. So again, has the department endeavored to take on any, and I don't offer this as a critique, more just an understanding, and to have any sort of a study as to, in the absence of such a program, what would the result be? Should the program be augmented, and should the program be made permanent? As Mr. Bryson pointed out, the renewal after renewal in some of the companies that I've spoken to causes some concern, because these companies don't work just on annual basis, as you can understand. They do an exploration season, but that is usually connected to at least 2 or 3 or 4 seasons all strung together. And to be able to plan not knowing what the revenue take-up will be like from the market is difficult. Does the department have a study of the effectiveness of the tax credit, and has it contemplated the making of it permanent as a program?
Well, I mean, with respect to every measure, there's a decision that's taken as to whether or not to continue to do it, to not do it, to change it in some fashion. I can only speak to the fact that the department, well, the government has decided to continue this credit on an annual basis. I'm not aware of any study to look at the specific kind of impact that you're talking about. Sometimes, I mean, in terms of evaluating the utility of credits, the department also relies on input from stakeholders, and certainly there's been input.
So to be explicit then, do you study the effectiveness of other tax program, industrial-focused tax programs like this? Does the department ever take on the assessment, whether from stakeholders or internal data or StatsCan data? Do you do this, or is it something that you don't? Leave it to the AG or PBO or other groups to analyze effectiveness?
Certainly, well, I guess the department conducts a whole host of studies. I think I would be getting out of my depth as senior legislative chief here to explain these particular tax measures, to start talking generally about the kind of economic analysis the department undertakes.
Okay. It's a curiosity for me. Last piece, and I'll leave off on this. You've mentioned several factors that go into this particular assessment as the department decides to whether renew, end the program, or even contemplation of making it permanent. You mentioned pricing of metals and the recent depression in metals. Are there any other factors that you consider within the department when the renewal of this tax credit is being debated?
Well, I mean, in terms of how this credit is assessed, I mean, there's the relevant commodity prices, there's the global strength of the industry, and the levels of investment that are being undertaken by firms in the industry. So what you would think of as the general economic conditions applicable.
Thank you, Chair.
Okay, thank you. Okay, Mr. Cullen, Part 1. Part 1, Mr. Allen, please.
Thank you very much, Mr. Chair. And I'd like to ask a few questions with respect to unlegislated tax measures. And the first question is, does Finance keep a running record of these measures? And if so, I'm assuming you do, how many unlegislated measures are still out there, given there was about a 983-page catch-up bill after 10 years, which was done about a year or so ago. So can you answer that?
In terms of the unlegislated tax measures, just to explain, I mean, when we talk about like specific legislative proposals, certainly the Department of Finance keeps a public listing on its website of draft legislation which has been released for comment or provided to the public, and so there is a listing on the website of all our proposals. And you're quite right. There was a bill of close to 1,000 pages that was enacted just last year. So certainly we've done a lot in terms of dealing what you would consider the legislative backlog. I guess the one figure I would note that we've looked at recently, the Office of the Auditor General, when they audited the Department of Finance back in 2009, they indicated that there were approximately they'd identified 400 technical amendments, of which 250 were outstanding comfort letters. In terms of those comfort letters, there's, I believe, less than 10 that have not been either enacted, otherwise dealt with, or released in draft. In terms of legislation that we've currently got outstanding, there are a couple of budget measures from 2012 that we've been doing consultation on: bank base erosion, life insurance policy exemption. But certainly we've been working very, as I'm sure this committee knows, we've been working very hard to sort of come up to date.
Next question is with respect to the way the legislation is worded. It would contemplate a report in 2014, this fall, of the first report that would go to be tabled in the House of Commons. And then, given there will be an election in 2015 in October, that means obviously the reporting period wouldn't be in line with the reporting period. So would the next report of this come immediately when the House is brought back into session after the 2015 election? This is going to be a two-part question. And then the second one would be, given that it's a different mandate of a government at that point in time, does that mean that the next report would be in 2017 or 2018?
Without a chart in front of me, I always get sort of lost in the years. But to give kind of an overview, what the proposed amendments to the Financial Administration Act that you're talking about would do is essentially require legislative proposals that had been made sort of more than 18 months prior to the October to be tabled. There would be no obligation to table if there was no legislative proposals meeting that criteria, which would likely be the case in the first year of a new government. And so what the measure would do is require legislative proposals that had not been enacted, that had been announced but not enacted during that period, to be listed in Parliament. And again, that's just to give greater transparency as to the progress of tax legislation. Obviously, tax is kind of special in the sense that usually they have an effective date as of announcement, as opposed to when it's finally enacted.
Third question is, you have a general, in 162.3, there's a general intention to develop, there's an exclusion if there's a general intention to develop a specific legislative proposal. How would you see that general, kind of that, call it general intention, actually playing out in fact? Well,
the purpose of the legislation is to assist Parliament and taxpayers and the CRA with legislative proposals that are coalesced enough, usually, that they will be taxpayers will order their affairs based on those legislative proposals, and the CRA will begin administering based on those. What we didn't want to do was, I'll give you an example. In Economic Action Plan 2014, there's consultations relating to tax planning by multinational corporations, where there is an intention to develop a proposal, but we're at the consultation stage, or the proposal hasn't coalesced enough to be sort of an identifiable legislative proposal that taxpayers might be relying on. The idea was that those would not be appropriately reportable. In fact, it might be sort of it might be less helpful if just the fact that the government is consulting on something, if that were to be included in a list of outstanding tax measures.
Okay, thank you, Chair.
Okay, thank you, Mr. Allen. Now, colleagues, the next person I have, Mr. Bryson, has some questions. So. Okay, I'll go to Mr. Bryson for your questions.
Thank you. I'd like the donations of certified cultural property. This measure, I understand, is the result of concerns that tax promoters were abusing the system. Can you tell us about that and how this measure will fix it, or could fix it?
Certainly. The Income Tax Act has a provision that provides that in certain circumstances where property is acquired and then subsequently donated to a charity, that the fair market value of the property for purposes of the charitable donations tax credit will be the lesser of the cost of the property and its fair market value. This will apply where the property is acquired as part of a tax shelter, or when the property is given to a charity in a short period, less than 3 years, or I believe it's 10 years if it can be reasonably concluded that one of the purposes of the arrangement is to obtain the tax benefits. There's an exception from that rule for certified cultural property that currently exists. The concern is that certified cultural property could be starting to be targeted by tax promoters to be engaging in what are essentially sort of buy low, donate high schemes, where you would buy at one price, say $300,000, and then you would have it as certified cultural property at $100,000, and there's a valuation which is certified by the board, and then donate at that value.
A Sotheby's or a Christie's or someone like that price be accredited in terms of being able to provide a price on one of these assets?
Well, there's two responses to that. The way it currently works for the review board that certifies the cultural property, at the time they give the certification, they'll actually certify the fair market value of it. Now, to assist the board in doing its certification, there'll be an independent appraisal provided by the person who's seeking the certification. For the majority of the time currently, the appraisal which is provided to the board will be accepted by the board, and I think the concern is at least partly that puts a lot of pressure on the board to, with respect to due diligence around the appraisal. Now, I would note that this amendment only applies to certified cultural property that is donated as part of a gifting arrangement that's a tax shelter, so there's certain requirements around representations and whatnot. So it shouldn't affect other gifts of certified cultural property.
Concerns about punishing legitimate donors or reducing their incentive to donate cultural property?
Well, as I just mentioned, this exception to the exception, if you will, that we're putting in only applies to gifting arrangements that are part of a tax shelter. And to qualify as a gifting arrangement that's a tax shelter, there has to be statements and representations with respect to the tax benefits which will be given. So in the case of someone who actually has property they've just acquired and at some point they decide that they want to donate it, then this measure would not apply to them. So we don't think it will affect sort of the genuine type of donations that you're talking about.
Okay. I'd like to move on to combating tax non-compliance. This measure expands CRA's ability to share information with FINTRAC. What kind of new information will be shared? Does it include the personal information of Canadians?
In terms of, I'll just situate that amendment. Currently, FINTRAC can provide information to the CRA for its enforcement purposes if certain criteria are met, and so it has to be kind of relevant for FINTRAC purposes, and it has to be related to certain CRA purposes. What this measure does is allows CRA just to provide information back to FINTRAC relating to how useful the information provided was.
To be clear, does it include personal information on Canadians?
Well, it could potentially. For example, if someone was convicted of tax evasion and they wanted to let FINTRAC know that in fact was the result of the information that was provided.
What limits are in place to prevent FINTRAC from further sharing that information? Can FINTRAC, for instance, share it with any organizations outside of government? Can they share it with other countries?
Well, in terms of FINTRAC, this is, sorry, I'll just turn to the exact provision, because really we're talking about information that FINTRAC provided to the CRA in the first place. So, sorry, I'll just flip to the exact provision. So I would just note that the actual amendment provides that it's to an official of FINTRAC solely for the purpose of enabling the centre to evaluate the usefulness of information provided by the centre. So it's solely for that purpose. And the underlying information itself that was provided in the first place is, FINTRAC's information itself.
Okay. Question on the Offshore Tax Information Program. This program was launched in January 2014. So how much money is this program expected to bring in? Has the government set any targets? Budget 2013, which announced the program, didn't include any estimates.
And I think that, in fact, there are no specific targets as yet with respect to the amount of money to be brought in. I mean, there is some experience with the U.S. has its own programs, and they've raised between sort of in at least one of their programs, they've raised between $93 and $250 million a year on their program since 2006.
For Canadians following this committee today, there may be some questions about the state's borders of terrorism and which countries would this measure apply to, but also what is the process of adding a country to the list as a supporter of terrorism?
I can't really talk about the process of these of that act because I'm obviously not an expert in that domain. But what I can tell you is basically that there's already a robust legal framework for addressing terrorist financing, and a very strong legislation regulating charities that protects the sector from potential abuse, and that also obviously terrorist financing is a complex and multifaceted issue, and that framework already includes a number of legislation, and including the criminal code, the Proceeds of Crime, Money Laundering, Terrorist Financing Act, the Special Economic Measure Act. And what this measure in the budget does is that it adds another piece of legislation to that toolbox, if you will. But I cannot really talk more about the process for listing these countries under that act.
Thank you. Thank you. Your time's up, Mr. Bryson. Okay. So I'm going to move to part two then. I will thank our two officials, and I believe we'll be asking Monsieur Messin to come forward, please. Part two, amendments to the Excise Tax Act, GST, HST measures. Okay, welcome. Bienvenue, Monsieur Michel.
Merci.
Welcome.
Okay. We'll start with Mr. Cullen, please.
Chair, I'll keep this incredibly brief. It's actually not a question for Mr. Marcel, just more a position on our process, as Mr. Keddy was asking about, or learning about how we're doing here today. Our preoccupation is that our ability to actually get through parts 5 and 6 around FATCA, and certainly the details of almost 30 sections in part 6. So we're not going to, the official opposition is not going to ask any questions on Part 2 in order to enable as much time for the committee as possible to get into some of the more complex parts of this omnibus legislation. So we'll leave it at that, but we have some, as you are always concerned with and aware of the time, some worries about our process here this afternoon.
Okay, thank you. I have Mr. Keddy, and if I can, colleagues, we have 4 hours in total with officials and the minister, so if we can be very brief in our questions and answers in order to get through everything. So we'll go to Mr. Keddy. Yeah.
Mr. Chairman, in relative to Mr. Cullen's statement, we're in agreement, so I'll refrain from my question.
Okay. No. Mr. Bryson, any questions on Part 2?
Yes, I do have questions on Part 2. Starting with the GST, HST, and the healthcare sector. This exemption for services provided by acupuncturists and naturopathic doctors is only available in certain provinces. In which provinces are Canadians not able to benefit from this measure?
I'm just going to correct you. The exemption apply across Canada for both the GST and the HST. Maybe I can explain why maybe there's a confusion here. So there are administrative criteria that are used to decide which healthcare profession would benefit from the exemption. And one of those criteria is that the profession is regulated as a healthcare profession in at least 5 provinces. But when that criteria is met, usually an association would make representation to the government asking to be exempt, and then there would be a decision made by the minister to exempt. But once it's exempt across Canada.
Provinces currently
you want to know which one
would not benefit? Which provinces would not because of the provincial regulatory differences?
No, they will all benefit. The way it works is that we list acupuncturists or naturopathic doctors, and they have to be regulated in a province. And like I say, the exemption will apply across Canada. If an acupuncturist is in a province that there's no regulation, as long as they meet the qualification to be regulated in another province, that would be good enough to benefit from the exemption.
Thank you. Go on to GST and HST on paid parking. The measure to charge these taxes on parking provided by charities in cases where 90% or more of the parking is usually provided for free. I recall there was a similar provision for public sector bodies in Bill C-4. And I understand that measure resulted from a tax dispute with a number of municipalities where about $50 or $60 million of revenue was at stake. Have there been any tax disputes with charities regarding this measure? And if so, how much money was at stake?
We're not aware of any. It was made just to be uniform across the board.
Okay. That's all for Part 2. I've got some.
That's it for Part 2? Okay. Thank you very much, Mr. Massel. I'll just ask colleagues, are there questions for Part 3, amendments to the excise tax 2001? There are questions? Okay, we'll bring the official forward for Part 3. Monsieur Coulombe. Oui, bienvenue à cette comité.
Welcome to the committee.
With Mr. Keddy, then.
Thank you, Mr. Chairman. I've got one very brief question on the tobacco products. I think most of the countries have plotted initiatives to increase tax on tobacco and apply them on tobacco products, those taxes straight across the board on tobacco products. But do we have any reasonable idea on how much actually is expected, how much revenue is expected to come from the increased tax on tobacco?
Thank you for the question. Actually, if you take the budget documentation that was released on February 12th, I think this is on page 319, and you will have the details per year of the increased revenues, and they amounts to about 3.3 billion over the next 5 years, plus the 2 months of the last fiscal year.
Perfect. Thank you. That's it.
Okay, thank you very much, Mr. Keddy. Mr. Bryson, please.
Following on Mr. Keddy's question on taxation on tobacco, in the past, high tobacco taxes contributed to a significant growth in underground market for cigarettes. And when the government announced these measures in Budget 2014, they also announced money to find contraband tobacco. Page 237 of Budget 2014 shows that there will be $45 million spent to fight contraband tobacco over the next 2 years. How much of the $45 million is new money? And if it's not new money, what was the original purpose of the funds, i.e. how much money is coming from existing RCMP budgets?
Thank you again for the question. This kind of spending questions unfortunately falls outside my area of expertise, as we are responsible for the enactment of the Excise Act 2001, the legislative amendments that make it possible to have the duty increase in place. However, my understanding is that a similar question was addressed in the previous briefing. We could surely follow up with internally with our parliamentary affairs to ensure that the appropriate response is provided. But I do not have with me any details in terms of what that 91.7 million over 5 years or the other profile over 2 years of funding to the RCMP are referring to.
Endeavor to get back to us in a timely manner early in the week would be helpful given the timing of this. The concern is that if the money is actually coming from the existing RCMP budget, the RCMP have faced significant cuts, $195 million to its actual budget, and the Auditor General is already concerned that the RCMP cannot meet existing obligations without new funding. So setting aside, say, $20 million per year while $195 million per year is getting cut, that doesn't necessarily help the RCMP meet additional responsibilities that could result from the unintended but highly likely consequence of a growth in underground market for cigarettes as a result of these taxes. So that's it for part 3.
That's it for part 3. Okay, thank you. Merci, Mr. Coulombe.
Thank you, Mr. Coulombe.
Does anyone have any questions on part 4, customs tariff? One question on, okay, we'll ask the 2 officials to come forward. Okay. We have Mr. Halley, is it Halley? And Monsieur Toussaint. Bienvenue. Thank you for being with us here today.
Welcome.
Do you have a question? No. Okay, we'll go to Mr. Keddy first then, please.
Thank you, Mr. Chairman. I started this question earlier, but it was in the wrong spot in the discussion. The 20% most favored nation rate of duty on mobile drilling rigs, the elimination of that duty at a time when there's a scarcity of oil rigs worldwide should assist more offshore drilling for gas and oil in Canada, without question. But the link is to small business and the supply of those oil rigs. Do we have any hard numbers or any theoretical numbers even on how much assistance this will give to small business, specifically in the service industry?
Sure. Well, as the budget mentioned, this measure lowers business costs for offshore exploration by about $13 million annually. There's also spin-off benefits. The industry has indicated that over the last 4 years in Canadian shipyards, there was repair work or maintenance work done on these rigs when they come into Canadian waters, and that's about $40 million a year on average.
Okay, that's it. Thank you.
Thank you very much. Mr. Bryson, please.
I have one area I'm interested in, the tariff classification of certain imported food products. I understand that the measure in clauses 91 and 92 they're in response to, it's in response to certain pizza products. Could you explain this to us?
Sure. What clauses 91, 92 are doing is they clarify the tariff classification of certain food products that contain cheese, which is a product that falls under the supply management system for certain agricultural products, which is subject to high level of duties. The clarification addresses a gap whereby certain imported goods were packaged in a deliberate manner solely to circumvent the current tariff structure, which has, as I said, very high supply management tariffs on mozzarella cheese, which is part of that food product. The tariff is 245.5%. And so what 91, 92, what they're doing is they clarify how these products or how the components of these products should be classified, i.e. the cheese should be classified as cheese and any other component should be classified under the appropriate tariff item.
Were the measures related to some court disputes?
I'm sorry?
Were the measures related to any court disputes?
Well, it's an issue that was brought to our attention, and I think this was circumventing the import controls pillar, and so the clarification addresses that gap with respect to ensuring the integrity of the import controls pillar of the supply management system.
What's the expected fiscal impact of clauses 91 and 92?
Well, there's no impact. This is solely a clarification to essentially clarify how these products should be classified, as essentially a loophole was found in the way that the tariff structure was originally drafted. So this only clarifies how these products should be classified.
Thank you.
Thank you.
Thank you. So too. Thank you. I want to thank our officials for being with us on Part 4. We have next Part 5, which I know there are a number of questions from a number of members on, so I'll ask those three officials to come forward. Colleagues, we've got less than an hour left. I'm presuming this may take up the rest of the time here today. Am I safe in presuming that? Yes. So can I, on your behalf, then, the officials for Part 6, can I release them from the committee for today and ask them to come back on Tuesday? Is that a fair thing?
Yeah, why don't we? Would it make sense, Mr. Chair, would it make sense to have the officials for the first part of Part 6 available, nothing else, in the event that we don't use all the time on FATCA?
Why don't we keep the first 4 divisions for now, and we'll see how the time goes. Okay. Is that fair? I want to be as fair as possible to the officials in the room. And, yeah. Okay, is that good?
Fair, Chair.
Fair, Chair.
I have the best chair in Parliament here, so I have to. I'm under his mindful watch. Okay. Of course, you're all free to stay and watch the committee as well. Okay, I want to welcome Mr. Cook back to the table. We also have Mr. Brian Ernwine, who's often before our committee. Welcome back.
Thank you.
And Mr. Kevin Schum, who's been before us as well. And colleagues, I think I'm going to start with Mr. Rankin for a 7-minute round, please. Mr. Rankin, please.
Thank you, and thank you very much to the witnesses for being here. The intergovernmental agreement related to FATCA, without doubt, is one of the most complicated provisions of Bill C-31, and we've taken the position as the official opposition that it deserves a great deal more study than it is going to get through this process, and thus we've suggested that it be taken out and given the study that's required. Now, just in terms of timelines, I'm coming to a question, but the context is this, that it's less than 3 months since February 5th and the agreement being signed, and here we are today. I'm correct. I hope I'd ask you to correct me that the public was given 30 days to comment, and now it's part of this omnibus budget. And it seems to me that it's undue haste given the enormous consequences of it. So my question to the officials is, in your judgment, have you had adequate time to understand the intended and unintended consequences of such a dramatic piece of legislation?
Thank you for the question. The answer is yes. I think the question that you're asking, though, is whether others have had the sufficient opportunity to consider its implications. And we believe the answer to that is yes as well. I would make the point that, yes, the agreement was signed on I think, February 5th of this year, so a couple of months ago. However, the announcement of our intention to negotiate such an agreement was announced November 2012? In November of 2012. And in this case, it's a negotiation based on a model agreement which the U.S. had in the public domain. And so that, together with the release of draft legislation, the implementing legislation that's before you today in draft form and with some revisions as a result of consultations, was also released later on in the same day that we signed the agreement. And so that also enables an opportunity for discussion and comment.
So I've spoken to a number of tax lawyers. I'm going to Toronto tonight to talk to some more, and they certainly feel, the ones I've talked to, the consequences are enormous, and they don't feel they've had enough time, but your judgment is there has been enough time. Have you done an estimate as to how many dual citizens or so-called accidental Americans are covered by this law?
Well, I very much take that as two separate questions. In terms of how many, it's not limited to dual citizens to start. U.S. citizens that are living here, even if they are not Canadian citizens, can be affected by the obligation to identify themselves and to be reported on. That because the U.S. tax base includes taxation on the basis of citizenship. In terms of how many U.S. citizens are living in Canada, dual, that is Canada, U.S. citizens or otherwise, we don't know the number. It's commonly suggested there's 1 million plus or minus.
Which is the number that I've heard bandied about as well, as one that that's your working assumption.
Well, I mean, that's what we were told, or that's what we're given to understand. You referred also to accidental American.
Yes.
I mean, that's a function of whether people came to understand they were American citizens or thought they'd given it up over time or the like. I'm not aware of any statistics being compiled.
Canadians married to U.S. persons, as that term is defined in FATCA, children who were born in the United States but had no relationship to that country in their entire life, those people living in Canada are also subject to it. Is that part of the 1 million you estimate?
My understanding is that the estimate that's been used includes all persons who are actually American citizens living in Canada, and I might take it to include them being, whether they're citizens or aware of being citizens or not, that they're counted.
We had a briefing with officials, as you know, and I'd like to follow up on that briefing because there was a lot of information that we weren't able to get then. First of all, there are, as you well know, very serious concerns that the intergovernmental agreement would violate the privacy rights of Canada and Canadians. Members were told at that briefing that the Department of Finance, or CRA, neither had received an opinion from the Office of the Privacy Commissioner of Canada. Do you now know where the Privacy Commissioner stands?
I wasn't clear. You said we had not received an opinion?
That was what was told. Well, that's what we were told when we had the briefing.
Yes, I'm sorry, and it was probably I who said that, and that was true then, and it is true now. It's not our understanding that the Privacy Commissioner offers opinions on proposed legislation, and so
consultations with her office.
We've kept the Office of the Privacy Commissioner informed and involved in discussions throughout this, including sharing with them the draft legislation.
Have you commissioned independent legal opinions on the implications of this law for either the Privacy Act or the Personal Information Protection and Electronic Documents Act?
It is our understanding that the FATCA itself would have raised potential privacy issues because that involved a foreign law ostensibly requiring the provision of information from Canadian financial institutions in relation to Canadians. There certainly seemed to be a privacy issue there and a potential conflict with our privacy law. Our understanding is that in relation to Canadian law, that the Privacy Act and its various provisions are subject to other laws of Parliament. And so the proposal before you is to change Canada's laws to require financial institutions to collect certain information in respect of their customers or clientele. We believe if that law is in place, that would be read in concert with the Privacy Act. That is, the Privacy Act would be subject to that other law. The other aspect of that, to give you a complete answer, is on the provision of that information when it goes to the Canada Revenue Agency on to the United States, our treaty partner. To that, we think there's an exemption also for laws of Parliament. There already is in the statutes of Canada, the Income Tax Act, provision to exchange information pursuant to our bilateral tax treaties.
Did I understand you to say just now that you think that this law, this part of Bill C-31, would be somehow subject, would not be subject to the Privacy Act, which is a quasi-constitutional law? Are you saying that?
My understanding is that the Privacy Act allows for other laws of Canada, other acts of Parliament, to be read together.
To be read together, but in such a conflict, it's the Privacy Act that prevails. You're not saying anything different, are you?
Okay. Just a brief response. This will be something I think we'll have to come back to. Brief response, Mr. Arnold.
My understanding is that another law of Parliament can be sort of read together with the Privacy Act, so the Privacy Act will not be in conflict with it.
Okay, thank you. Mr. Saxton, please.
Thank you, Chair. And I'd like to continue along the same questioning regarding the Foreign Account Tax Compliance Act, or more commonly known as FATCA. Now, the absence of an intergovernmental agreement, an IGA, would have meant that there still would have been an obligation on Canadian financial institutions to comply with FATCA. It would have been a unilateral and automatic obligation imposed by the United States that would have come into effect on July the 1st, 2014. Can you please explain what would be the consequences for Canadians and financial institutions had the IGA not been arrived at?
Thank you. I think it's a very important question. It's not, to be clear to this committee, I don't think it is the case that it was a question of whether to do this intergovernmental agreement or nothing. It was a question of whether this intergovernmental agreement would be, how it would compare relative to the U.S. Congressional Act, or the Hire Act, and the provisions of FATCA within it. FATCA itself would have required non-financial institutions, non-U.S. financial institutions, so including Canadian financial institutions, to sign agreements with the Internal Revenue Service under which they'd have to undertake due diligence on their own accounts, that is to identify their U.S. account holders and report on those directly to the Internal Revenue Service. In some circumstances, financial institutions would be required to withhold 30% of payments that were made to their account holders, or alternatively potentially to close those accounts, again in possible conflict with Canadian law. And a financial institution which decided not to enter into such an agreement with the Internal Revenue Service would itself be subject to 30% withholding on payments going to it and to its clients from U.S. sources. So that raises, as we've already had a discussion about, concerns about privacy laws, the potential application of the 30% withholding tax and the impact on financial institutions and indeed the financial system, the possible requirement to close accounts, and really a grave compliance burden for everybody, affecting both financial institutions and of course, their clients. And so we think the intergovernmental agreement addresses a lot of that by eliminating the withholding tax issue, eliminating the risk of potential account closure, addressing, we think, the issue with Privacy Act, and by virtue of some of the exemptions we've obtained for financial institutions not having to report, and on a large number of registered accounts not having to be reported on, the compliance burden is not eliminated, but is much moderated.
So as a result, as a direct result of the IGA, Canadian financial institutions will be saving a tremendous amount of resources, financial, administrative time, as a result of the benefits of the IGA. Would you agree with that?
I would agree with that. I think for them and their clients, it's certainly not, in their view, something perfect from financial institutions' perspective, but I think it's much better.
And it also helps to protect Canadian laws.
Well, it doesn't raise the conflict of laws issue that we talked about earlier. I believe that's true.
Okay, thank you very much. Now, due to the fact that we now have an IGA, which was negotiated by our late Finance Minister, Jim Flaherty, we were able to get concessions from the U.S. concessions that other countries probably didn't get. Can you just elaborate on some of the exemptions and the concessions that we were able to achieve through the negotiations of the IGA?
Certainly. First of all, I do want to say that that the U.S. sought as much as possible to have identity in the agreements they negotiated with every country. Understandably, if they're trying to negotiate with the world, and I think they've signed as of today 30 of these agreements, they weren't much minded to be very novel. So that made it very difficult, but a tougher discussion. But we did push to achieve as much as we could in relation to Canada. The two types of exemption, the key I would identify, so I don't take up the whole hour with this answer, are for small financial institutions, those having less than $175 million in assets, and also another definition, those which had more than 98% or 98% or more of their client base was Canadian, and no sort of other multinational group. They weren't part of a multinational group. Those institutions themselves would be exempt from reporting. Now, I rush to add that's common to other agreements as well. Something that's specific to Canada is the exclusion of a wide range of accounts, specifically registered accounts. It's not a complete list, but it's nearly so. Registered retirement savings plans, registered retirement income funds, pooled registered pension plans generally, tax-free savings accounts, registered disability savings plans, registered education savings plans, and deferred profit sharing plans are all exempt from reporting under the IGA in support of FATCA.
So just to summarize then, Canadian financial institutions and Canadians are much better off as a result of this negotiated intergovernmental agreement than they would have been in the absence of an agreement.
If as opposed to FATCA itself applying, there would have been many, many more issues and a much higher compliance burden in that circumstance. So on that measure, yes, I'd say they were much better off. We are much better off as a result of this agreement.
Thank you very much. Thank you, Chair.
Saxton, we will go to Mr. Bryson, please.
Thank you, Mr. Chair. I'd like to actually follow on with the discussion of the RESPs and RDSPs. These both include matching grants provided by the federal government. Of course, these grants are intended to help families saving for post-secondary education or helping disabled Canadians avoid poverty. They weren't intended to somehow make their way into the U.S. Treasury. How does the U.S. treat these Canadian or view these Canadian registered accounts? And are they, if a Canadian were to volunteer the information to the Americans or someone who is considered a U.S. person, a Canadian who's considered a U.S. person under FATCA, are they subject to federal U.S. taxes?
Thanks again for the question. So first of all, the U.S. does have, actually the very first thing I should say is that this question only came up quite recently and we hadn't considered it before. As a result of subsequent discussions, we learned that the U.S. hadn't considered it before either, but having received the question, it was good to try to sort through the answer. So the second thing I will say is that, yes, U.S. citizens are subject to U.S. tax, which means that if you're a U.S. citizen resident in Canada, you're essentially exposed to both the Canadian and the U.S. tax system. From that, to get to your point about RESPs and RDSPs, we do not tax the government grants when they go into the plan. That's kind of antithetical to the point. But when those grants or other income generated by the plan do come out of the plan in the beneficiary's hands, they are subject to Canadian tax. Ideally, the U.S., if they chose to tax it at all, would try to match that taxation to tax it at that time. So we would tax, and then if there's citizenship tax on top of that, and there rarely would be, but if there were, then the timing would be right. We've had the opportunity to discuss this with the U.S. since the question has been asked of us. As I said, they hadn't considered the question before, but based on the description of the plans we've provided them, they've told us that indeed they consider there to be no taxation at the time of the contribution of the grant or other contribution to either of these types of plan, but when the amount comes out and represents income to us, they would consider it to represent income for U.S. purposes too. So there'd be taxation at the same time.
So earnings on the grant, the contribution by the Canadian government, to these accounts, earnings on those grants would be taxed upon withdrawal by the Americans.
The grants themselves and the earnings thereon, my understanding of the answer we've been received is that those are taxable on receipt by the beneficiary.
Okay, I'm sorry.
Yes,
I just want you said when the grants go in to the accounts, they're not considered taxable by the Americans.
That's right. That's my understanding.
Yes, but in the future, when there's a withdrawal from the account for a Canadian with a disability or a young Canadian who's cashing in part of their RESP for their education, at that point, it would be considered taxable by the Americans on the way out.
Yeah. The specific question we've had a discussion with the U.S. about was in relation to the grants themselves, and on that they've said that because of the conditionality of it, it's not clear that these will go out to the beneficiary. They would be included in income for U.S. tax purposes only at the same time and to the same extent as they would be for Canadian tax purposes. That is on payout.
Just to be clear,
yes.
When there's a withdrawal from these accounts, the earnings on, and in fact the capital from the contribution by the Canadian taxpayer, those will be taxed by the Americans. So, and this is this is what I think a lot of Canadians, taxpayers and citizens would view it as perverse, that the Canadian taxpayer is funding grants into these accounts, RESP and RDSPs, to help people with disabilities or to help their children get a good education, and ultimately that the American Treasury is benefiting from that. That it would not make a lot of sense to Canadians making these contributions.
Well, you made reference to contributions. If you're talking about capital contributions by the parent or other subscriber,
but on their way out.
Right. The question wasn't discussed with the U.S. by my recollection, but I don't believe that there's a question of their taxing it because that's not income by any measure. The question we had before and that we asked was about the grants themselves, the government grants that go into these, and these are taxable by us. The U.S. view was that it appeared to be income to the beneficiary if and only if it actually went to the beneficiary, if all the conditions were satisfied. But that would also be the point at which we're taxing, and so it would be matching up and quite conceivably no additional U.S. tax as a result.
Yeah, so on the way out, when people are withdrawing from them, that will be considered taxable.
The grants themselves, what we understand, yes.
Yeah.
As we do.
The question on the if a Canadian disagrees with the finding that they are a U.S. person, is there an appeals process? How does that work?
This question is in relation to the intergovernmental agreement, or more generally in terms of U.S. taxability.
If they're considered a U.S. person under FATCA, they are and they don't want to be, what is the appeal process?
Don't want to be. Let's take the position
pretty significant incentive not to
right.
be.
Well, first of all, whether or not somebody is subject to U.S. tax as a U.S. taxpayer, as a U.S. resident or as a U.S. citizen, is a question of factor law or mixed factor law. So, I mean, that stands separate from the intergovernmental agreement itself. The intergovernmental agreement is strictly about information reporting. If the question is about how one figures out or sorts out an assertion by the U.S. that they're American residents for tax purposes and they disagree with that, the tax treaty can have relevance to that in terms of determining breaking the tie between our two countries' laws, which find to be resident under both. Our tax treaty also sorts out for Canadian residents, and I mean real residents, who are U.S. citizens, and I mean real citizens, in terms of the pecking order of taxation. But if you're speaking about the intergovernmental agreement itself, that's really a question as between the taxpayer and the financial institution they're dealing with, and perhaps your question relates to what does the financial institution do when the person says, I am not a U.S. person. In that circumstance, it's often the case, or generally the case, that the financial institution relies on what they're told by the by the person, in the absence of clear contradictory evidence.
Okay.
I'm sorry, I've tried to cover everything there, but...
Thank you. Thank you. Thank you, Mr. Bryson. We'll go to Mr. Keddy, please.
Thank you, Mr. Chairman. I've just a couple of points of clarification. Mr. Bryson, in his question, stated Canadian citizens, and I think what he meant was American citizens living in Canada, and whether they're American citizens by default because they happen to be born in the United States but had never officially taken out citizenship and moved to Canada at a very young age, that's immaterial really to this discussion. The difficulty here is that the Americans have engaged in a far-reaching tax policy that taxes American citizens who live outside of the geographical boundaries of the United States. However, there are a number of things that that person can do. They can renounce their American citizenship if they don't want to pay American taxes, and that's not been suggested here, but that's the reality of this situation. And there are many American citizens living in Canada, and many that I know, who have been paying taxes for years in the States on U.S. investments and on any investments they have that pertain to America. So a lot of people have been, following the rules. So we've got an intergovernmental agreement. We have a situation where, because of this, Canadian financial institutions will not have to report directly to the IRS. So, this protects Canadian privacy, and I think that's what most of us here are really worried about, is protecting that financial privacy of Canadian citizens. And, as for American citizens living in Canada, they have some tough decisions that they have to make on whether or not they want to continue to be American citizens and pay American tax when they're living offshore. But how far does this go to protect that financial information of Canadian citizens and dual citizens, American citizens living in Canada and dual citizens?
Well, first of all, if the earlier question had made reference to Canadian citizens, yes, I thought we were talking about U.S. citizens living here or American residents. So thank you for pointing that out. The second point, although it wasn't your question, I will say that there really is I think it should be emphasized that there's a difference here between what the U.S. does in terms of its tax base, including taxation of citizens, and what the intergovernmental agreement does. We don't tax citizens. Perhaps no other country apart from the U.S. does tax on a citizenship basis, and in our view it leads to a lot of issues. That's clear. But as to whether or not they're entitled to enforce their laws, we've kind of accepted since probably our first tax treaty with them in the 40s that they can, and this is part of that. Now, by virtue of my preamble, I've lost your question, sir. I'm sorry.
The protection of material by not reporting directly to the IRS.
Yes, thank you. So, by virtue of the model or the intergovernmental agreement, and this is a very important point to Minister Flaherty, that we would use the protections of the existing Canada-U.S. treaty and our own protections. So, under the Canada-U.S. treaty and indeed our other treaties, this information can only go to the revenue authorities, the IRS. It can only be used for the purpose of taxation and not for other purposes. It's subject to strict safeguards. It's also collected by our own revenue agency for transmission, as opposed to having information being provided directly by Canadian taxpayers, financial institutions, to foreign authorities. And so there's this sort of whole architecture, if you will, around the collection and sharing internationally or bilaterally of tax information that comes into play when you use the procedure that this agreement does. In addition to the other advantages that Mr. Saxton we talked about, I think this is a very important one and should not be lost sight of.
Yeah, that's good. Thank you.
Mr. Keddy, go back to Mr. Rankin then, please.
Thank you, Chair. I want to pursue the issue of, we talked about privacy, constitutionality of this intergovernmental agreement. As you may know, the leading constitutional lawyer of Canada, Mr. Peter Hogg, has said it's unconstitutional. One of our leading constitutional lawyers, Joseph Arve, is now embarked in a constitutional challenge to this law. My question is, at the briefing, your officials told us that the Minister and Department of Justice are responsible to make sure that our laws are consistent with our Constitution. However, legal experts have said that the intergovernmental agreement implicitly repeals a number of laws. Since our meeting, have you obtained an opinion from the Department of Justice on the constitutionality or from outside counsel?
Well, may I be clear, first of all, I think there's two separate legal questions that may have been bundled up in yours. One is whether or not the changes, whether it's possible for Parliament to enact a law requiring the collection of information, and whether or not, by virtue of that law, the Privacy Act makes space for it to apply. That was my point before. I think that that's the way the laws work, is that the Privacy Act says that it's subject to other acts of Parliament, and so if Parliament enacts a law for the collection of information, as is proposed, or if Parliament enacts a law, as it has already done, for the sharing of information, that I think the Privacy Act, as I say, makes space for that. But I think the other point, a separate point you're making, is whether or not there's a constitutional issue with this legislation, and my understanding of Mr. Hogg's view is he thought that there might be some claim that because there's at least part of this that's based on collection of information determined by reference to citizenship, that could be an issue. I'm afraid I don't know Mr. Arve's, is it, views on that. The direct answer to your question on the constitutional point is that the Minister of Justice is charged with conveying to Parliament a view, if it ever arises that there's a constitutional or charter issue with the legislation. It has been examined, and there's no such view been conveyed.
You therefore have a legal opinion from Justice or outside counsel to that effect?
The Minister of Justice, as I understand it, has discharged his responsibility to review the legislation and assess it on constitutional grounds, charter grounds.
And you spoke about privacy a moment ago, but we're talking about the inequality of our dual citizens and their rights being different than others. That aspect has been examined as well? It was the second or latter aspect that I was speaking about in terms of what I understand to be the constitutional question that some have raised, that it's suggested that there's been a charter issue that's been examined by our Minister of Justice or Department of Justice. But I'm not sure, I'm not at liberty, and I'm certainly not qualified to speak to the opinion. I want to talk now about the cost of this. We were told at our briefing, we asked you how much it would cost for the CRA to implement this agreement, and we were told then that the department had not produced cost estimates, which we found quite shocking. Here we are at this bill at committee stage. Today, do you know what the cost, I guess my question's, I'm going to break down the cost. The cost for the CRA to implement the agreement is one category, and sort of the direct cost to the Government of Canada, as well as any estimates you have of the costs to the banks and other financial institutions to deal with this law. Let me stop it at that. Those two levels of costs. Do you have that now?
Yes, thank you. I was participating in that parliamentary briefing and made the point that we didn't have it then, but we'd use it as notice to ask our CRA colleagues. And Kevin, the paging has changed. I'm sorry, we have the number. I'm just having trouble locating it. Sorry, I'll run from memory. I think I have it right. The CRA has sought to put together an estimate. I think it is still subject to approval by the parliamentary committee, but the numbers are an estimate of $5.7 million to the CRA, to be precise about your question. $5.7 million over the next 5 years to implement this regime. There's some additional costs because of the IT, the information technology requirements that are associated. And CRA's estimate at this point is that on an ongoing basis, the cost of this would be in the order of something like in the order of $715,000 annually.
Annually. And the other part of my question was relating to the banks. I have it here that the Scotiabank, one of Canada's large banks, has spent almost $100 million implementing a system to report to the United States the account holdings of Canadians of American origin and their Canadian-born spouses in order to comply. That's one bank, not credit unions and not the other banks. Have you had any, in your discussions or consultations, a global figure as to the cost of our financial institutions to comply with this law?
No, that I can't speak to. We have heard that $100 million figure was used actually very early on by one or more of the banks as a very rough estimate, but I frankly don't recall any longer whether it was in relation to FATCA or I think it was in relation to FATCA rather than this new model. My suggestion would be to if I could be permitted to make this to ask the banks.
Yes, so I want to ask you, because you presumably had some kind of consultations with financial institutions. It would seem to be a question that might have come up. $100 million for one bank, and I guess my question is, that's either presumably going to be passed on to all Canadians. It's not just U.S. persons, in other words, who will pay that. It would be all of us Scotiabank customers, for example, or shareholders who will get less return. Isn't that logical?
Well, I want to be clear, first of all, that I'm not subscribing to the number, because I don't know if it is the right number. I also want to make the point that, sort of apropos the point that Mr. Saxton made, the scope of the obligations on financial institutions and on their clients is much reduced by virtue of this agreement as compared to what FATCA itself would have required. It's not a current statistic, but when the government announced the tax-free savings account a few years ago, it made the point that over the course of time, 90% of taxpayers will be in a position to have all of their savings in registered accounts. And so on that basis, it gives you an indication of sort of the helpfulness of this agreement in relation to FATCA itself.
Got 10 seconds. I can come back to you in another round.
Thank you. Thank you, Chair.
Okay. We'll go to Mr. Allen, please.
Mr. Chair, and thank you to our witnesses. Just want to follow up on that, on the last line of questioning from Mr. Rankin. With respect to the cost to the bank, one way or another, this was going to happen to the banks, either way. So I guess to say the banks would have been better off under this, the cost that they were going to incur, they would have had to incur a cost anyway to meet the requirement of actually directly reporting to the U.S., which might have even been more. Is that correct?
I think I can say without really any hesitation that it certainly would have been more. This is certainly an obligation on the banks, and I've made the point more recently in another discussion that I'm sure the banks aren't tickled by this, even with what we have done, but I do think that they would take the position, have taken the position, and would continue to take the position that this is much less onerous on them than the alternative would have been. That's not to say they like it, but I think they consider it superior to what otherwise would have been done, and as I say, for themselves and for their clients.
Okay. Just want to ask you a few things with respect to, I mean, when you look at the citizens who are in Canada, and you can put them in a bunch of broad categories. You can put the ones who have worked in the U.S. are now living in Canada, the ones who are actually maybe U.S. citizens, all the way to the extent of U.S. citizens by accident of birth because they happen to live in a border community and the U.S. hospital was the only one that happened to be open, so sorry, but you were born in the U.S., so tickety-boo, there you go. So with that in mind, what do we, and then you have your dual citizens, of course, which some of those would be. What does FATCA do to ensure the protection of these citizens living in Canada against like any possible penalties from the IRS, and where is the line as to where CRA will help or not help the IRS collect or act against someone living in Canada?
Thank you. So this is purely an information agreement. So it's about collecting information and from financial institutions and providing that information through the Canada Revenue Agency to the CRA. As to what assistance and collection provisions we have with the United States, there is such a provision for the last 15 or 18 years, perhaps, in the Canada-U.S. treaty. There has been provision in that treaty for Canada and the U.S. Canada and the U.S. revenue authorities to help each other in the assistance and collection of taxes. However, that does not apply to penalties outside of the tax system, and it also does not apply to citizens. And so, for any dual citizen who might be discovered and assessed a U.S. tax liability, the treaty does not allow assistance in collection in relation to that person because they are a Canadian citizen. If they were only a U.S. citizen, then it's possible that the collection assistance provisions could apply, but there are other considerations that have to be weighed before that rule kicks in. It has to be in relation to the basic tax or tax-related, and only after the final tax liability has been determined.
So for a permanent resident, it might well apply, as opposed to a citizen, a dual.
If they're not a Canadian citizen,
Right. Okay.
yes. That's right.
How does this compare, when you look at the exchange of information that's coming under FATCA, how does that compare to our existing tax exchange? And I guess there'd probably be a lot of detail within the existing tax exchange agreements, but is it comparable information? Because I can't imagine it would be the same as, for example, tax exchange for tax evasion, for example. So how does this compare to existing provisions within our tax exchange agreement?
It's a very good but very involved question. At a high level, I will say this, that we already do collect, first of all, we already require entities and other taxpayers that are making payments to non-residents to identify those payments and to provide that information to Revenue Canada. And when the payment is going to a resident of the U.S., there is already exchange of information that happens. And indeed, when you or I invest in the U.S. and receive some income from the U.S. will send us a form. They'll also send their IRS a form, and that information will be exchanged with Canada as well on at least the basic sources of income. And so in that respect, it's not different what FATCA does. However, FATCA does nonetheless go further. In relation to that example I've given, it seeks a bit more information, not only the account holder and the financial institution. It requires that the taxpayer identification number, it's a U.S. tax identifier, be provided. It looks for the account balance to come, not just the amount of income that went, but the account balance also to be provided. And the other aspect of it at a very high level that I think is different is the so-called due diligence procedure. I call it FATCA. Under the intergovernmental agreement, there's a bit more digging required by the financial institutions to follow up on markers or indicia of a U.S. connection, whether it's a U.S. address or the like, to find out whether there's a real U.S. connection there, and if it proves out that the person is actually a U.S. person, then the information is to be provided. But it's not novel in the sense that we already do collect information on payments going to non-residents, not based on citizenship, but on residents, and that information is reported to the Canada Revenue Agency and shared with our treaty partners.
Does this agreement have a reciprocity provision in it?
It does. And so we'll be collecting some additional information from the U.S., particularly in relation to what I've talked about as taxpayer identification numbers. I do want to say, though, for completeness, that it's not at the same level at the outset. The U.S. has asked the countries that enter into these IGAs to provide the information that I've talked about, to do the due diligence procedures that I've talked about as well. They aren't actually undertaking to do all of that immediately themselves. They're doing some of that I've referred to. There's a commitment in the agreement that they will work towards that equivalent treatment.
Okay, thank you, Mr. Allen. Mr. Rankin, please.
Chair. When we talk about U.S. persons, are we talking about individuals alone, or are we talking about corporations and other entities?
We are not talking about individuals alone. We've often, because that's where the conversation has led, talk about U.S. residents and citizens, but there's some relevance to entities as well. If you'd like, we can give you some more information on the entities.
Yes, just what the scope of, here's where I'm going with the question. I mean, is there any, if it does cover corporate persons or other trusts or the like that are subject to this as U.S. persons, has there been any study done on the implications, for example, of improperly revealed information that might harm the competitiveness of industries in Canada, or entities, as you put it, in Canada?
Well, to answer that question first, and then if you're still interested, we can talk about how the rules work in relation to entities. It's the same restrictions on the use of taxpayer information that I talked about earlier that would apply to there. There is a question of reliance and reliability of the foreign country with which we are exchanging information that comes into play on this. The conditions for provision of information, whether it relates to individuals or to entities, is that the information can only be used for tax purposes and not otherwise.
And that's what the document says, but once it's in U.S. hands, Canada has no control over how it may be used in the United States.
That's right. There's a question of, as I say, sort of the reliability of our treaty partner. We do take the view that we can rely on the U.S. to limit its use of the tax information, as indeed they rely on us.
Indeed, and so it might be that information could well find itself, as we've seen in other contexts with the United States taking our information. There's a USA Patriot Act. There's a number of other statutes that where the information on Canadian/U.S. persons could well find its way in other entities. We're just relying on their statement that they're not going to do so.
Well, that would be inconsistent with their commitments to us and their legislation, and so it would only be on the basis that they were violating the agreement that would happen.
So you haven't, I'm sorry, the question about whether you did a study on the implication for the competitiveness of Canadian entities if their information were found in the United States. Has there been any analysis undertaken?
Well, I think we challenged the answer is no, because we challenged the premise of the question that the
promise to not do so.
We exchange information already with the U.S. and with other treaty partners on which we rely on the terms of the agreement we have with them.
And what about the interference with cross-border mobility of Canadian workers going to the United States? Those with green cards, for example, they're going to be subject to costly tax compliance measures after they return to Canada. Has there been any analysis done of the implications for that sort of cadre of Canadian workers?
Forgive me, I'm not sure if I understand how they're affected
People
in the way
who
you
are
suggest.
Green card holders, think Windsor, for example, of people going across the United States that actually work there, will maybe enhanced scrutiny of their tax situation as a consequence of this FATCA. Is that an analysis? Is there any issues we need to be worried about with cross-border mobility? Maybe not.
Yeah, I don't know of any. I guess I'm just to take the specific example you raise. If there's a person who's living in Canada, but while a green card holder, so actually living in the U.S.,
living in Canada, working in the United States with under a green card that goes back and forth regularly.
All right. Well, in those circumstances, they'd be exposed, if you want to call it that, to the U.S. tax system already. Their income would be subject to U.S. tax by virtue of employment, by virtue of U.S. employment.
There would be no enhanced concern as a consequence.
Not that it occurs to me.
All right. I just want to ask, because we talked earlier about the reciprocity of this, and a lot of people have been challenging that notion that this was reciprocal. Under international law, as I understand it, there needs to be gains to both countries as a consequence of an international agreement such as this. And what gains, I'd like to know if any analysis has been done of the gains to Canada we achieve by entering into an agreement of this sort. I understand the lack of economic sanctions is a gain, if you will, but what about other gains for us? Is there a reciprocal agreement that the United States has entered into? Talk about those things, the gains and the reciprocity.
Thank you. So yes, I thank you for acknowledging at least that there is this point about issues avoided. I think there also is the point that we do gain some additional information immediately from the U.S. in relation to the collection of taxpayer identification numbers, which will help in our own data matching. That's immediately. We also do have the commitment. It's not delivered immediately, but the commitment to full equivalence, if you will, over time. The other thing I would add, and you might consider this a soft point, but I think it's worthwhile, even though FATCA itself started off kind of badly in the sense that what it first proposed raised a lot of issues for a lot of us and a lot of taxpayers, the development of the intergovernmental agreement seems to us a good thing in terms of advancing exchange of information. It still has a lot of issues, in particular with the U.S. on citizenship, but as a matter of principle, it seems to us to be something you can, that enhances taxpayer compliance. The point I want to make is that I think as a result of the discussion around FATCA and the intergovernmental agreements, countries, particularly the G20, have now moved forward to trying to adopt an automatic exchange of information procedure or standard. It's coming to be known as the Common Reporting Standard. It's still under development, but G20 finance ministers and G20 leaders have committed to working to bring that to reality. And whether it's grudgingly or not, I think that the FATCA discussion and debate has sort of led to some of that evolution.
Okay, 1 minute.
There are scholars that are going to be testifying to this committee who indicate that FATCA is inconsistent with the terms of the existing tax treaty we have between Canada and the United States, because it provides for appropriate changes to the treaty that they say the intergovernmental agreement explicitly implements the FATCA agreement, but superficially only appears to meet the standard, and that the IGA introduces an unprecedented asymmetry in the treaty. and they recommend that the government explain why normal treaty amendment processes haven't been followed, and we have this asymmetry introduced into Canada. Do you have any comments on that analysis, that lack of symmetry?
These, just to help situate myself, these are the comments by Arthur Cofield or
That's correct.
SES.
Yes, exactly.
Well, the immediate asymmetry and ongoing sort of quest for symmetry is something that sort of it can be the subject of comment, and people could think that or suggest that Canada ought to have sought immediate symmetry or reciprocity or equivalence and not agreed to it without having done so. I would say that it's what we've done on that basis is the same platform as the other 29 countries or jurisdictions that have agreed to it. To respond more directly to the question, I don't view it as I don't understand that it's a legal question. I think we can provide benefits to another country, and they can provide different benefits to us. I don't think that the fact that there's the suite, if you will, is different makes it an illegal agreement. So that I just don't understand.
Okay. I think I'm out of time.
Thank you, Mr. Rankin. We'll go to Mr. Saxton, please.
Thank you, Chair, and I'll share my time with the Chair. I just wanted to mention, Mr. Irwin, you were responsible for negotiating a big part of this IGA, were you not?
I had a role in it, yes, sir.
As well as Mr. Schum as well. So, okay, well, on behalf of Canadians and our government, I want to thank you both for negotiating this IGA, which is a significant improvement over the FATCA, and it's leaving us in a much better position as a result of your efforts. So I'd like to thank you both for those efforts.
Well, thank you.
Mr. Chair.
Thank you, Mr. Saxton. I just wanted to pose some very basic questions here. I'm getting a fair amount of correspondence on this, as you can imagine, and when I'm phoning people back, I'm saying, are you talking about FATCA or are you talking about the IGA? And many people actually believe FATCA is Canadian legislation that is somehow included in Bill C-31. So when I explain the difference in that, FATCA is U.S. legislation that takes effect whether the Canadian government acts or not, and the IGA is in fact a response to that. You stated very clearly before this committee that we didn't have a choice of doing nothing, but just for argument's sake, suppose the Canadian government did not negotiate the IGA, and suppose for argument's sake that Canadian financial institutions chose not to comply with FATCA, for argument's sake. If they said, we're just not going to comply with this U.S. legislation, what would be the repercussions to those institutions and thus to Canadians?
Thank you. First of all, can I just make a comment that I think that people, whether or not they're, yes, I think people do confuse FATCA with IGA, where in fact the IGA displaces FATCA. It says instead of FATCA we will do this. So that is an important point. I would also say that as a result of FATCA and the discussion around it and FBAR a couple of years ago, I think that there's a number of Canadians, accidental Americans or otherwise, who are kind of becoming aware of the issues of U.S. citizenship taxation. And so that's an issue more generally. It doesn't relate to this, but it's spurred on, I think, by this. So I'll just say that quickly. I'll answer your question.
You're correct, because many people actually link all of those issues together.
I think that's right. So in the absence of an IGA, and I don't want to sound apocalyptic, but there were very, very serious issues. The U.S. said it was about exchange of information, and it's always been about exchange of information, but their penalty, their lever under FATCA to get information was to impose a 30% withholding tax on payments made from the U.S. to foreign financial institutions, a wide range of payments, not just interest and dividends, but possible derivative transactions and other things. To be apocalyptic for a moment, it appeared to us and to people, our colleagues in the financial sector area, that it essentially would shut out a bank or other financial institution from any interaction with the U.S. markets, which I don't think was the U.S. goal, but it could have been the effect. It also wouldn't have helped for those financial institutions that wanted to comply with FATCA and found some way to overcome the privacy conflicts that we think existed with doing it. Their clientele would have been subject to not just the same requirements as this legislation, but much more onerous requirements. All of their accounts, including registered accounts, would have been subject to examination, and the account closure could have been a consequence of it, and withholding tax could have been applied by them. Ostensibly, there would have been a debate about this, but in fact, the Canadian financial institution would have been required to withhold on payments made to its own Canadian customers on behalf of the United States. So I don't mean to, as I say, to go overboard, but I think that there would have been real serious consequences for the financial system generally, and not a better world for Canadian financial institutions or for Canadian customers.
I appreciate that clarification. Can I then, so for a financial institution, say like TD Bank, I mean, TD Bank, something we should be proud of, actually has more branches in the United States than it has in Canada, headquartered here in Canada. But if say they as an institution said, you know, we're just not going to comply with FATCA, it seems to me that's not even an option for them. I mean, what would be the repercussions for that institution if they chose not to comply with the U.S. legislation?
I think that any of their U.S. presence would have been sort of separate and apart from this, but in relation to their Canadian operations and indeed their third country operations outside of the U.S., it would have been as I described. That is to say, they would have had these issues with either being, in some sense, shut out of the U.S. market or having to do the same thing as the intergovernmental agreement would require, but a much more wider scope and much more onerous basis.
I'll just add that part of the FATCA withholding that could have potentially applied to a Canadian financial institution, let's say with U.S. subsidiaries, is that any remittances from the U.S. to Canada associated with those subsidiaries could have been subject to the 30% withholding tax. So if a Canadian financial institution were attempting to access liquidity through dividends from the foreign affiliate or from the U.S. affiliate, or through loans from that foreign affiliate, those could potentially have been subject to withholding tax. And potentially also if the financial institution attempted to divest itself of those U.S. assets, then the withholding tax could have applied to the gross proceeds associated with that divestment.
Okay. I've only got about a minute left, and the other topic I think is going to take a longer time, but the committee has received a brief from Moody's Gartner tax law. Have you, as department officials, been aware of their concerns? And I don't think you'll have time to address them here with respect to the definition of financial institutions, but perhaps if you want to provide a short comment now and then perhaps provide something in writing to the committee to address that.
Well, we are aware of the comment. I can give you a moment now, and then we can see where that takes us. Yes, we are aware of their view. It's that we haven't fully complied with effectively our commitment and agreement with the United States and what we've done in our implementing legislation. We, in fact, think we have. To give you a very quick overview of it, the intergovernmental agreement has a series of definitions of financial, or a definition of financial institution with sub-definitions. What we have done in our implementing legislation is to say that there's a specific list of regulated financial institutions that are required to report under the intergovernmental agreement under our implementation of it. They're suggesting that we've left some stuff off the list, that there's something in the intergovernmental agreement in relation to the definition of financial institution which is not captured in our list. The difference seems to be based on the fact that the intergovernmental agreement has kind of a functional definition of what a financial institution does, that is describing it by its operations, and then says it's to be informed by the Financial Action Task Force definitions of financial institution. We've taken that Financial Action Task Force definition, which is found in our own anti-money laundering legislation. I'm getting to the end shortly. Our own anti-money laundering legislation, and we think that actually does conform with the agreement and delivers what was intended.
Okay, I appreciate that very much, and I appreciate your appearance here today. I'm suspecting there are some more questions on Part 5. Yes, I'm correct on that. So. Colleagues, on Tuesday we will start with the Minister. I believe we have the Minister for an hour. We will then we'll start back with Part 5, so we'll have our three officials back, and then we'll move to Part 6. If I could just have colleagues' attention for 1 minute, please. Just to indicate, on May the 28th, the estimates meeting, because the Leader of the Opposition, I believe, has designated finance and transport as the two departments for Committee of the Whole estimates, that in fact that supersedes our committee for the meeting on May the 28th. So the meeting on May the 28th will not happen. So the calendar will be adjusted, but obviously members will want to be there in the House for the Committee of the Whole debates. So that was the meeting on the estimates. Okay. So the estimates will be dealt with in the House. I want to thank our officials for being here. Thank you, colleagues. If I could ask the members of the subcommittee perhaps to stay after just for a couple minutes, I just want to get their reaction to something very quickly. Thank you.